clearly the correction that we've seen in Treasury markets is long overdue and consistent with Fed tapering. I suspect if we're looking at a normalization of yields, we have further to go, and I think next year will be another bad year for bond markets. But this, after all, is the long overdue correction, from what have been incredibly bullish markets since 2007. And if we talked about, 10-year yields getting down to 2%, then we would have looked very odd. So I think this continues. I think the story of weak bond markets, bullish equity markets continues. Remember, the world economy should be looking at much stronger growth in 2014 and better balanced growth, less reliant on emerging markets, more reliant on developed economies. So I think this story has another 2 years to run.
2 years, okay. And no early rate cut from the ECB?
Indeed, I think Draghi has already said that there's no need for urgent action. It looks to me as if the ECB are using forward guidance now. We're going to keep rates low, but they seem to feel that the crisis has passed, no need to panic. So again, we won't be looking for another rate cut at the start of the new year.
How worried are you by France next year? Obviously, it's in the news today. This millionaires tax has gone through. You don't expect to make much difference to you?
Indeed, we think really it's symbolic. Remember, it's on the individual rather than the household, so companies have to pay it to get around a constitutional court, and it's only good for 2 years. It gets repealed in 2015, so people who are affected by these sorts of earnings can clearly push them around. I think essentially the football clubs will be the most generous donor to the French tax coffers, but this is symbolic. I think, again, a country where the tax ratio is really about 46% of GDP, really trying to squeeze a few extra percent out of tax will not work. We are very concerned that the French economy next year underperforms. It's almost on the verge of another technical recession, and I think the message from the government of higher taxes rather than spending cuts is one that will give them difficulties, and I think there's plenty of room for political unrest in France through 2014, and an economy that's just about growing at zero, that means that the chances of a technical recession are higher.
Let's get a quick final word on emerging markets. Turkey, and I mentioned Sochi at the top, Russia and Volgograd. How do you expect the markets to react to things like this going forward?
I think, well, essentially, as we're seeing in Turkey through the political crisis, the stock market's taken a battering. The currency, less so. The Turkish lira has sort of gone from 2 to 2.15 in December. Meanwhile, the main stock markets collapsed from 74,000 down to about 64. So the impact's rather been seen more in equity markets than necessarily in FX, where I think fears of central bank intervention have curtailed some of those moves. We've seen a similar trend really in South Africa, where the rand looks to have kept some support at around 17, certainly to sterling. So equity markets take the hit. I think on Russia, the most expensive Olympics ever held, I think now looking at the latest figures of revisions, I think again fear of terrorism of course gets normally seen through equity markets.